Welcome back to the Deep Dive. Today, we're looking at a company our sources are calling, well, a textbook growth stock. That mix of a solid foundation and this really revolutionary pipeline. We're digging into the sources around Vertex Pharmaceuticals, ticker VRTX. And the mission today, figure out if it's really set up to be a, quote, big winner long term. Even though, let's be honest, no biotech is ever truly bulletproof.
Right. That term textbook growth stock is interesting. It sort of implies that stability and the big upside potential. And the main thing we found, really the core idea, is this growth times 3 strategy Vertex has. They're not just relying on one thing anymore, not one product, not one area.
And the numbers right now, they definitely scream stability. We had a market cap of $109 billion, trading around 425%. And get this, a gross margin of 86.08%. That's just huge. For listeners maybe not as familiar with biotech, just how staggering is that 86%? What does it really tell us?
It tells you they have total control, basically. In pharma, anything over 75% is seen as exceptional. So 86%, well, it means they have almost no competition. And their costs, like manufacturing, distribution, they're tiny compared to the price they charge. That margin, that's the engine, it's the cash machine that's funding this whole massive pipeline we need to talk about.
Okay, let's break down this growth then. Starting with growth path 1, the sort of safest, most established part, fortifying their base in cystic fibrosis, or CF.
Yeah, this is where they started. Vertex pretty much has a monopoly globally on treatments that address the underlying cause of CF. Their main drug, Trikafta, it's the giant. It brought in something like 86% of their total revenue just in Q2 2025.
Okay, but here's the thing the sources jump on right away. If CF is the easiest path to growth, why did sales for Trikafta only go up, 4% year over year in that same quarter? That feels like the market's pretty saturated, right?
That's exactly the point. It's a crucial insight here. Growth Path 1, it isn't really about massive revenue growth anymore. It's more about optimizing their profitability structure. The revenue growth is slowing down because, frankly, they've already reached most of the estimated 109,000 CF patients worldwide who can take their current drug.
Right, and that leads us to the new CF therapy, Alyftrek. FDA approved, December 2024? So, hang on. They're bringing out a better drug that they expect will basically steal or cannibalize most of the sales from their biggest earner, Trikafta. That sounds counterintuitive, like shooting yourself in the foot financially if you only look at revenue. What's the real play here?
But it's actually the opposite. It's smart, financially speaking. Alyftrek is better. Yes, efficacy, the convenience of once-a-day dosing, that helps lock down their market leadership for another 2 decades. But the really critical piece is this. Alyftrek carries a much, much lower royalty burden compared to their older CF drugs.
Ah, okay. So this isn't about the top-line number. It's about the profit and loss statement.
Exactly right. Alyftrek probably won't boost Vertex's total CF revenue by a huge amount, but it will significantly boost their operating profits because they get rid of a big chunk of those royalty payments tied to the older drugs. So they're securing their core business until 2039 and cutting their cost structure at the same time. Path 1 is all about profit growth.
Okay, that makes a lot more sense now. Better product, secure market, lower costs. Win-win-win for them. All right, let's move beyond that foundation then. Growth path 2, exploring new markets outside of CF. What approved products are already helping them diversify?
So beyond CF, they've got 2 approved products already out there that are, frankly, huge breakthroughs. The first one is Casgevy.
And Casgevy isn't just another drug, is it? It represents something much bigger technologically.
Oh, absolutely. The fascinating thing about Casgevy is that it's the first approved CRISPR gene editing therapy ever. That's a landmark moment, really, for the whole field. It shows Vertex isn't just a drug company. They're leaders in this totally new kind of genetic medicine. It's approved for 2 serious rare blood disorders, sickle cell disease and transfusion-dependent beta thalassemia. Just having that technology platform opens up so many possibilities for Growth Path 3 later on.
And the second non-CF drug, Journavx's sources sounded really positive about that one, too.
Yeah, they see Journavx as a potential no-brainer blockbuster drug candidate. That's the term they used. It's a non-opioid treatment for acute pain. The big deal here is the potential scale. It tackles a huge market needs safe, effective pain relief without all the addiction problems of opioids. So that gives them really important diversification and potentially a very strong revenue stream completely outside of rare diseases.
Okay, so Casgevy shows off their cutting-edge tech. Journavx gets them into mass-market medicine. But now we're moving beyond what's already approved and hitting what you call the real moonshot potential growth path 3. This is where the patient numbers jump from thousands to millions, right? This is really about scaling up.
This is the pivot. This is the part that could, quite easily, become much bigger than the first two paths combined. We're talking about the company shifting focus from treating rare conditions to tackling major chronic diseases, conditions that affect, hundreds of thousands, even millions of people.
Let's start with one of the really exciting ones, type 1 diabetes.
Right. They're working on something called Zimislecel. It's an islet cell therapy. And the goal here is essentially a one-time functional cure for severe type 1 diabetes. I mean, if this works, it's a complete game changer. Vertex thinks they'll be filing for global approvals next year. The initial target is maybe around 60,000 patients with the most severe form of the disease.
Wow, a functional cure. And then there's a whole push into kidney diseases too, I saw.
Precisely. Yeah, there are a few different candidates and conditions like IgA nephropathy, APOL-mediated kidney disease, candidates like povetacicept and inaxaplin. But instead of getting lost in the medical terms, the key takeaway is just the sheer number of potential patients. These kidney conditions alone, they affect roughly 800,000 people combined, just in the US and Europe.
And this is where the scale shift really hits you, the thing we talked about. If you add up all these major clinical programs they have going, the diabetes one, the kidney drugs, others we haven't even detailed, the target patient populations combined are over 2.75 million people.
That change in scale is just, it's massive. Remember, the entire global market for CF, their current bread and butter, is estimated at maybe 109,000 people. So Vertex is actively going after new markets that are, 25 times bigger than their established base.
It's almost like they spent decades perfecting how to make the world's most intricate, high-end watch. And now they're taking that skill and that 86% margin cash flow and deciding to build, performance cars for the masses. It's a totally different scale of manufacturing, distribution, everything.
That's a good analogy. And they're even using their existing drugs to aim for these huge markets, too. Like, they've got late-stage studies trying to get Journavx, that non-opioid pain drug, approved for diabetic peripheral neuropathy. That condition affects over 2 million patients. So it's like a multi-front attack on these really large-scale chronic diseases.
Okay. So path one, the profit engine is secured. Path two, diversification is already approved and happening. Path three, there's an enormous pipeline potential. But if you're an investor, especially in biotech, you're always thinking about risk. What are the things that provide some comfort here? What offers stability?
Well, there are two main comfort factors, according to the sources. First is economic resilience, because their main products, like Kaftrio, Trikafta, and now Aliftrek, are so essential for CF patients, and they have that near monopoly. The business is probably not going to get hit hard by an economic downturn or, say, tariffs. People need these life-saving meds regardless of the economy.
Right, essential medicines are definitely recession resistant. Okay, what about the big one for pharma? The patent cliff. I mean, protection until 2039 or 2040 sounds amazing, but does that assume no new competition pops up, or that these huge new markets like type 1 diabetes will actually pay the premium prices Vertex will likely charge? How solid is that runway, really?
That's a fair question, and a necessary one. The sources really emphasize the current reality, which is that the runway against generics is long and well protected. Yes, patents on some older CF drugs expire in 2027, but Kaftrio Trikafta, the main money spinner now, that's protected until 2037. And Aliftrek, the new one boosting profits, lasts until 2039. Journavx is covered until 2040. So they have this huge intellectual property runway. Decades, really, to make Path 3 work before their core CF business faces that major generic threat.
Decades to execute on that 2.75 million patient pipeline.
Yeah.
Okay. So if that's protected, where's the main risk then? Because, like we said, nothing at this scale is truly bulletproof.
Well, the biggest risk is the one inherent to all drug development: clinical and regulatory failure. Pipeline drugs could just fail in late-stage trials, or they could work, but maybe regulators don't approve them or approve them with limitations. And you raised a good point earlier about scaling up. Are there risks in shifting to chronic diseases, needing different sales teams, different patient support? Did the sources touch on that operational scale-up risk?
Good question. What did the sources offer as a way to maybe mitigate those risks, the clinical failures or even the scaling challenges? The sheer number and diversity of the pipeline programs is really the main mitigation strategy. It addresses both points, in a way. The source material notes Vertex actually has a pretty good track record with its late-stage programs succeeding. But more than that, think of it like a huge ship with multiple engines. If one engine fails, the ship doesn't sink right. It just maybe slows down a bit. Vertex has so many shots on goal across so many different areas that the thinking is they could weather a setback or two, as the source put it, and still reach their long-term growth aims. One failure wouldn't derail the whole company. Right. So let's try to sum this up. The overall picture for you listening is this company moving from being a very focused, very profitable monopoly in CF to having this incredibly broad pipeline targeting millions of patients in totally new areas. And all this is backed up by, well, extremely high profits, a lot of cash, and patents stretching up for a long time.
That's basically it. The stock isn't guaranteed, it's not bulletproof. But the analysis suggests that if even just a few of these big pipeline candidates hit, the diabetes potential, the pain relief expansion, the kidney drugs, Vertex really should be a big winner over the long haul. It requires maybe, as the source said, just a little good luck on the pipeline front.
And maybe here's a final thought for you to consider, building on that scale change we discussed. What does it truly mean for a company like Vertex, one that mastered the complex niche world of rare disease treatment, to now pivot and target massive chronic conditions like type 1 diabetes or diabetic neuropathy, affecting potentially over 2.75 million people? That shift isn't just about getting bigger. It fundamentally changes the kind of company they are, the challenges they face, and the potential rewards. Definitely something to think about as you connect the dots from this deep dive.